Hey guys, Mark Yagi again here. I've got one for you. Oracle just reported some numbers. So I'm going to be talking a little bit about Oracle. Not a stock that you hear about too much these days, but they're stealthily really creating a really great chart. And this was a stock that back in the 90s was just killing it. And then they kind of went into this consolidation mode for a bunch of years. Didn't execute, kind of like Intel, but now they're reemerging from that. And they are a market leader, certainly what I'm looking at here. So let's take a look at the weekly. I'm going to look at the weekly, and you can see that the stock is breaking out on an earnings report today. The stock was supposed to make about $1.04, and they made $1.39. So they blew away street estimates. All the other numbers don't really matter. I could just tell you, if you look at this candle, it's a high volume candle on a 17% earnings increase, and the stock is breaking out. Now, you could see the high here is 146.59. About 146.70 is the breakout spot. So I would say, right in here is where you want to be buying it. If you would have known that the stock was going to go up to 155 or 160, actually it hit today, then you would have bought it there. But, we don't know. Sometimes, these earnings reports can go the other way. So you want to be really careful with this. But how do you get into the stock now? First of all, I don't like to chase stocks. So if you want to make this an earnings play, here are a couple statistics for you. First of all, 40% of stocks that break out fail. Okay, proper breakouts. I like to have 40% average daily volume increase on the breakout, and I think we're getting that today. I'll look at that in a second. But also, most stocks or many stocks come back and they test their breakout spot. So how do you play this? Well, that 146.70 is a critical spot. That's the breakout spot that it wants to come back and test. So what you want to do is you want to say, listen, I don't want to chase it, but how could I make money on this stock if I'm not in it? Well, the answer is selling puts. So if you take a look at this chart, I know it's a little bit different color, but now you can see this candle right here is the candle where we want to use that as our breakout spot. It's a pivot point of 146.70. It's a nice high volume candle. You can see a good volume candle right there. It's about double average volume, certainly more than 40%. So that is a great candle for what we're trying to do today. Okay? Now, what you want to do is say, well, I don't want to chase it, so how do I play this game? Well, the way you play it is you say, I'm going to get involved in Oracle by selling a put. Now, when you sell a put, you give somebody the right to make you buy the stock at a certain price. You like Oracle. We like Oracle. It's breaking out 146.70. So how do we get involved in that stock without buying it and getting involved in maybe even doing a covered call and limiting our upside at this point? Well, the market is yellow, almost red right now. So that means you shouldn't be chasing stocks because the probabilities are that we're going to have a lot of volatility and maybe some more down stuff going on. I know the Fed's lowering rates and that's going to supposedly make the market go up, but it isn't working right now. And so we'll see if this is a buy the rumor, sell the news. Okay, so looking down below here, we've got all of our puts are over here on the right side. And so what I like to do is I like to look for about a 30 delta. You can see the delta is here. Got a 32 delta right there. And so that would be the 152.50s. The stock is at about 156, 155.89 actually. So to me, that's a little too close for comfort. That's got a 33% chance of being in the money. Somehow to me, it seems like that's only $2 away. The stock was up big today. It was up $16. $2, $3 can move very quickly. So I'd rather be a little deeper in the money and get a little less money. So we've got a delta of 21 here, a 22% chance of being in the money. And you can see if I just sell these puts, I get 88 cents. So on 1,000 shares, you end up making $880. And you have to tie up about $155,000 to do that. Now, the cool thing, that's what's called a cash secured put. You have the cash to be able to get assigned that stock at 150. That would be the strike price that we're looking at right there. So we sell the put to somebody else. That gambler is buying a put. We get to pocket $880, but we don't even have to put out any money. It's just the money is sitting there. So the reason the puts are the dark side is because you have to really kind of root for the stock to go down. Like if we want this stock, it's got to go down below 150 before we get it. So we could go out and buy it, but now why not just sell the puts and pick up 88 cents? And you haven't had to take any money out of your wallet. You just had to have it sitting there, right? You could use margin if you have a margin account, things like that. But you just have that availability of money sitting there, and you make $880. Now, if you wanted to play this a different way, now I don't like this because we're in a yellow or a red market right now, but you could go to the other side over here and we could do covered calls. Now, covered calls are a little more natural to most of us that think stocks are going up. Now, this is on a breakout. It's on a gap away. And let's say we think that the stock is going up to, well, let's play this conservatively. How about that? So let's say that we're looking at the stock. We think it's still going to go higher, but you know what? We're happy to make some good money at the money. And the stock is right around 150, what do we say, 156? So it's a buck in the money or so. So what we're going to try to do is we're going to sell the calls. We're going to have to buy the stock and now tie up that $156,000, but we're going to sell the calls for $3.45. That's $1.89 in the money, okay? So we're going to pick up $3.45, and the covered return is going to be 69.34 if we can do this over and over again all year. Now, it just had numbers, and the premiums are a little bit inflated, but you can get a pretty decent return. Now, if you wanted to be even more conservative, you could go to the 150s, for example. Okay, 150s would get you $6.75, and that isn't too bad, right? $6.75 if you sell might get you a little bit more here. But let's say we just pick up $6.75. It's $5.89 in the money, so you'd only be picking up, like $1.75 on that particular position, and that's why this 3160 is what you would be getting for the year. But notice how your probability of being in the money is 75%. So would you rather have a 75% chance of being in the money and making a 31% return for the year, or would you rather go at the money or slightly in the money and say, I've got a 53% chance, but if it happens, because I get more juice, I end up making 67.43. I would probably go deeper in the money in this market. In another market, if I thought the stock was going to continue to go up, if we were green and we had all the probabilities on our side, I might say let's go out of the money and maybe we sell the 160s and we pick up $1.37 for the sell, and we got a 32.89% return on that if it stays the same, right? But if it goes up, we get to make that extra money, and we have a 28% chance of making that. So that's the way you can look at this this particular trade. Now, I like the fact that you can trade this without taking money out of your pocket. So if you want to just pick up the $880, to me, that's a safer trade. There's only a 22% chance you get exercised on that trade. And that means you could pocket money, maybe do it over and over and over again next week. And if it never comes back, all you're doing is making $880 a week on a trade that's similar to this. So hopefully that makes sense, and that's how you can capitalize on Oracle. Take care. See you on the next video.